General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
Okay, so let's knock this out. Bullish sentiment went way down. Cash on the side went up. And bearish sentiment is higher than usual. This week, our red folder news is Wednesday unemployment. And Thursday, PMI, manufacturing and services. As far as the Fed watch, we had 97% no change. Fed fund rate. The COT, significantly more. Oh, snap, it's not even typing. Significantly more short positions. When I was typing, where was it going? Nowhere. Significantly more short positions on the commercial side. I think on my chart, I want to add the yearly open. That's actually the best time to start buying. So the start of the year would be here. This is open price for the year. $20.25 open price. Save that. Cool. Significantly more short positions on the commercial side. I'm bullish still overall. Let's look here on this bar chart. You can see commercials are pushing up while non-commercials are selling. I'm also interested to see the seasonal open interest and all that stuff. High open interest rates. So here we got it on 12-month sale program. And we got open interest starting to go up. We're above seasonal. That's a bear sign. Let's put this in here. So 12-month have a sale program. Price action is bullish. And open interest is starting to turn up. Just in time for earnings season. This week for earnings, all we have is Netflix in the top 10. Or it's not even the top 10. Netflix is number 11 on the NASDAQ. It can move the market, even though it's not top 10. Anything else? We still got banks and some big names, but not top 10 big names. Let me double check, because sometimes you can miss like Google or something. It'll come in weird. But usually the good stuff is Tuesday, Wednesday, Thursday after market. Here's the top 10, just in case you don't got it. Just looking at the top down monthly. Order flow's bullish on the monthly. We're still kind of stuck in December's range. We wigged previous month's low, but nothing too significant. On the weekly, my weekly objective is previous week's high at 21,897. So weekly high is actually previous week's high. You can see how an order block took this high, came back to the order block, pushed the swing to go high. So this is retracement. Take out this internal range liquidity, and we're closing above this open price. So this is bullish. On the daily, you can see how we use this daily inversion fair value gap as a market structure shift. And this is really the first time we started respecting bullish levels, because if you look at this run down and this retracement, we didn't come back to retest the bullish level. We just retraced. Then we had this run down, took out this low retracement. We didn't come down to retest the bullish level. This one we came down. This blue line is like the weekly order block. We pushed up. This is our first retracement candle in the push up. And we respected 50% of this. And we respected the inversion fair value gap. Continue pushing up, created a new high. So you can see here, respect the bullish level, respect the bullish level. These other retracements didn't have that. So that shows you that we're reaching for something. This would be the low hanging fruit, 21,897. 4-hour chart. Kind of see within, we came down here. I would like to buy here if we do come all the way back down here, because we took this high. This would be a good area to buy. This order block that was created right here that caused this swing up to take that swing high. Also, this retracement could just seek the imbalance in this H4 fair value gap. Those are my interesting areas to buy. Low hanging fruit, first stop would be this 21,712.25. Final draw for the week will be here. This is the best possible price, but I don't know if Netflix can get us all the way up here, especially when we only have unemployment and PMI this week. We got the inauguration Monday. Also, Monday is a short day because of Martin Luther King Day. But those are my areas of interest. Just wait for them to get triggered, see if we get a reaction. We could just push up and then, I had to look for sales because it's not giving me an entry. H1, there's nothing new to add to the H1. By the time you done did monthly, weekly, daily, you can refine and say, oh, this is a H1 gap or this is a mini range that we're in. But that's not necessary. We can do that day by day. But that's what I'm thinking for the week. I'm going to do the logs and stuff. So Monday will come in tomorrow. That's pretty much the breakdown, the forecast for the week. Y'all have a good day. Peace.